What is going on, investors? Hopefully you guys are doing well out there. It was a gigantic week in the stock market. We have people wondering, is a crash coming in the stock market? Most of these stocks are now in a correction mode, down 10%, 20% in some cases, or more off of the highs that they made just maybe a few months ago. We had earnings this week from Meta, Apple, Amazon, and Microsoft. And we heard from Intel as well. Let's have a quick moment of silence for all the bulls in Intel. What is going on, investors? Hopefully you guys are doing well out there. That is right. It is time for the FAANG Stock Recap Show here on the Investor Channel, where every Friday we recap all the major news and the technical chart patterns from all the major FAANG stocks. We've got so much news to get to. We've got a ton of technical charts that are absolutely breaking down. Better not waste any time. Kick things off like we always do with Meta Platforms. Start of the week at 467.98. Not a lot of stocks up this week, but Meta was up nearly 4.4% to finish the week at 488.31. The company reported their earnings yesterday, or 2 days ago, Revenue came in at $39 billion. It was 22% growth. They gave us guidance for the third quarter, which was more than good enough for the expectations that were already set out there from Wall Street. We just got kind of really, really high level numbers from Meta, just showing you that their business is durable, and they just have this ad business which just continues to get better and better. But the company did signal that they are better be spending money right now on AI rather than to be too late. And on the conference call, they gave you some very specifics here. And they said next year we are planning for the compute clusters and data we'll need for the next several years. The amount of compute needed to train Llama 4 will likely be almost 10 times more than what we used to train Llama 3. And future models will continue to grow beyond that. And they go on to say that they'd rather risk building capacity before it's needed rather than waiting until it's too late. And we actually got some color on how many GPUs the company has. Meta's AI data centers already hold about 600,000 NVIDIA H100 GPUs, and they just told you that the next generation models are going to be 10 times larger, 10 times more compute is going to be needed, and future models are probably going to be higher than that. Now, you've got future models of NVIDIA GPUs that run more efficiently. I'm sure software and different techniques will be developed where maybe you don't need, 60 million of these GPUs. Maybe you need 6 million. But I think we're going to see further growth in the semiconductor sector. Certainly, we'll talk about it when we get to NVIDIA segment on today's show. Also, on our other channel, we're going to have the semiconductor show this weekend, where we'll be talking a lot about this. I think we're going to have a divergence in the stock market. We'll certainly talk about this also when we get to Amazon as well. Is you're going to have the companies like Meta, Google, Amazon, Microsoft that are spending a ton of money on these GPUs. And that money is already locked up in the bank from not only cash that companies already have, but future cash flows as well. Now, there's going to be a divergent, though. If you start looking at the consumer, you and I, shopping on Amazon, shopping at Target, Walmart, we're under pressure. We're under pressure from interest rates, under pressure from the labor market. And so I think you're going to have this separation. And we'll see if the market throws everything out, because I think if they do, there's going to be some great opportunities here, because these companies are telegraphing where they're going to spend their tens of billions of dollars. And look, NVIDIA doesn't rely on you and I to buy their product. Now, Mark Zuckerberg is reliant on the consumer, certainly from an ads perspective, certainly also from their new AR glasses. They continue to work on these, and they envision kind of a new era coming up. And they said that the Ray-Bans that we've had, we're not able to fit all of our tech into. Obviously, a pair of glasses, there are going to have to be advancements in battery and different types of computers. But Mark Zuckerberg says we're getting closer, and it might be 2 or 3 years away. My guess is this is like an Elon Musk timeline, where it's probably closer to 5 to 6 years away, but we want them to look great. I think Mark gets it. They need to look great. They also need to fit in a form factor that doesn't look like the Apple Vision Pro, which nobody is buying outside of influencers initially. You can't have a battery being tethered down. It just looks stupid, but I think we'll evolve, maybe not something to the form factor of normal glasses, but maybe something just slightly chunkier. I think you might have an interesting product. They said they're going to layer on Meta AI assistants along with other things. The company unveiled a new AI studio to let users create their own AI chatbots. And one thing that I thought was interesting, it's going to allow creators to build AI as an extension of themselves to answer common DM questions and story replies, helping them reach more people. I thought that's interesting. I got a lot of comments on my videos over the past couple of days. I would love to sit there and answer them all. I don't really think I want to create an AI custom model of myself, but maybe I'll sit down this weekend and try to get through more of them. We talked about how this company needs a ton of GPUs. First of all, they already have a ton of GPUs. They're telegraphing that they need more. We heard the same thing from Microsoft. We heard the same thing from Amazon. And I just think this pullback in semiconductors, you don't necessarily have to be moving in right now with both hands, like going all in with all your chips. But I think this pullback could end up being a gift. Now, moving on to Apple. Start of the week at 218. I mean, it was a rough week, but it wasn't a rough week for Apple as the shares slid higher just fractionally by about 1% to finish the week at 219.84. We heard from Apple earnings as well. I guess they were better than I thought. They weren't that great when I was going through the report, but maybe I'm numb to kind of large numbers, because when you take a step back and see that, look, in a quarter where they didn't really release anything very exciting, it's also a quarter before you're going to release a new iPhone. And so there's a lot of consumers, maybe myself, other people out there that are like, well, instead of buying the iPhone now, I'm just going to wait 2 months for the new one. You still put up revenue of $85.8 billion. That was 5% growth year over year. Beat expectations, which probably were reined in a little bit. Across the board, you're seeing some strength, particularly in iPad, as the company kind of unveiled some new models there. And so it's nice to see some growth. Also gives you hope when the company releases maybe a new version of the watch, maybe upgraded versions of Macintosh computers, which they continue to do. Well, you'll continue to see strong sales and potentially stronger sales growth. Now, I thought this was interesting. On Apple's unveiling of their Apple Intelligence, or AI, they indicated that it could be available for the iOS 18 launch, but it looks like Apple Intelligence won't be ready then. They are likely to give software developers access to it, though, in early testing as soon as this week through different types of beta testing. I am part of the developer program at Apple. I am able to get the beta software. This is something that I might install on my phone just because it's interesting and maybe to try it out. So it looks like to me, though, you might have a release of the new iPhone, but not the new software, which is widely the reason why you might want to upgrade. We've learned that Apple has used Google's chip technology to train 2 of their AI models for Apple Intelligence using Google's version 4 and version 5 cloud TPU clusters. Those cloud TPU clusters are co-designed by Google and Broadcom, so this is also likely a hat tip, if you will, to Broadcom. Now, moving on to Amazon, and here's where we're going to see a little bit of divergence in the FAANG stocks. The ones with exposure to the consumer could have a rougher road, as I think it's almost assured we're moving into at least a slowdown in the economy. Some people, some economists already predicting that we're either in recession or certainly headed for one. Now, Amazon obviously has a massive exposure to the consumer, but we'll talk about the AWS side as well. Amazon started this week at 183.48, down big, 8.76%. You have to see Amazon's chart technically. It is absolutely unbelievable. It's almost like everybody's looking at the same chart. 167.41 is where we end with Amazon. And I tell you what, who's sitting pretty right now is we've done maybe 4 or 5 press releases on Mr. Jeff Bezos unloading at the top again with Amazon. He's probably sitting back on his beautiful yacht somewhere in South Florida. Now, revenues came in at $148 billion. That was 10% growth year over year. AWS was good. I think the third quarter guidance was not good for Amazon. 154 to 158. The consensus was really over the high end, or close to the high end, at 158 billion and some change. And this is a quarter that includes Prime Day. They kind of pumped that up, said it was big. Well, clearly Prime Day might have been big, but the rest of the quarter is not looking good. Third-party sellers are under pressure. That 13% growth rate year over year on the third-party sellers that came underneath the expectations for Wall Street. That also kind of gave maybe a slightly underperforming from the advertising business. My guess is Amazon is going to have to be more aggressive, pushing promotions to the third-party sellers, pushing prices down as, again, the consumer, the average Joe consumer, the person with the job, the family man, the family wife, they are under pressure. But look, from the data center side, these companies have a boatload of cash. And somebody made a really nice comment and a question on our Amazon earnings video. They're like, well, what is Amazon going to do with their cash? They have a ton of cash. I think it's like $60 or $70 billion off the top of my head. That's a really good question. Well, one thing they're going to do is they're going to continue to invest in AWS. Over the first half of the year, CapEx was $30.5 billion. Some of that is a mix, likely, of fulfillment center, but also a data center. But, look, they said the majority of the spending that they're going to do will be higher in the second half. So they just spent $30.5 billion, and they just told investors that wasn't enough. We're going to spend even more. A lot of this is going to go fund AWS $105 billion annualized run rate. And so I think it creates a good opportunity for Amazon as we see shares continue to pull back, maybe stall out at the highs that they made just a couple of weeks ago. You got a $1.9 trillion market cap on this one. Probably doesn't include today's 9% drop. So you're under a $2 trillion valuation. You've got a cloud computing business with massively high gross margins at a $105 billion annualized run rate, growing at about 20%. So as we sit here next year, you're probably going to be 125, maybe upwards $130 billion in revenue there. Totally profitable. And then you've got this e-commerce business that is spun profitable as well, that is doing north of $100 billion of in quarterly revenue on its own. Yes, we'll move into kind of a slowdown in terms of consumer. They're going to have to be a little bit more aggressive on pricing, but that is going to impact Amazon's retail competitors as well. And typically during these times, the strong survive. And I think Amazon is going to survive and thrive coming out of it. Moving on to Netflix. Start of the week at 631, down 2.7% to finish the week at 614.78. Now, in a week where you had so much news everywhere else, this headline from Netflix flew under the radar a little bit. They filed a debt security shelf offering with no amount given. I thought this was interesting. It could be nothing. It could be that the company is just, this is kind of housekeeping. They just want to have, some options to raise some money here in the future. But I thought this was interesting that, what are they planning to use this money for? Netflix doesn't have, it's not one of like these other tech companies that we follow with tens of billions, maybe even $100 billion in cash. They're not there. And so Netflix got something up their sleeve here because they have enough operating cash flow and enough leverage inside of their own business. They don't really need cash to expand Netflix as it runs today. But could they be planning some kind of acquisition? That's the thing that came to mind. And so these types of things fly under the radar these types of weeks. But it wouldn't surprise me as we move into the back half of this year, maybe even early next year, that you get the finalization of this and you say, oh, Netflix is buying this or they're investing in this type of business. It'll be interesting to see what Netflix does. Moving over to NVIDIA, oh my goodness, start of the week at 116 as you had massive dislocation in the chip market, and NVIDIA was not immune to it, down over 7.5% to finish the week at 107.27. Now, everybody's starting to chime in at the top, right? They said Elliott Management says the bubble in AI theme is overhyped. These guys were probably, a lot of people were saying AI was a bubble last year. I can't tell you how many people this time last year were like, oh, AI is a bubble. And if you didn't listen to them, you could have made, actually more money in a year than most people make in a decade of investing. So these guys that call the bubble now, you have to wonder, were they calling this a bubble for the last 6 months when you could have made a ton of money in these stocks? B of A also coming in and saying the hype days are over as the market shifts to assessing investment payoffs. I think we're not here yet where the market is shifting to assessing investment payoffs. Because here's the thing. Yes, maybe on some of the smaller companies, but with Meta, They have a $30 and $40 billion ad business that just hides any damage that they might be doing somewhere else. Same with AWS. They got a $25 billion cloud computing business that really could use some more investment, and they've got plenty of cash. Google, Microsoft, all these companies are in the same boat. This is not like you and I, where we have a regular job and we have a mortgage and we have things that we like to do, and then all of a sudden we start to crank it up in terms of our expenses. Well, at some point, the wife's going to knock on the door and say, well, maybe you should pump the brakes on buying the Rolexes and the chains and the cars and things like that until we see some of these investments pay off. You don't have to do that at Meta. You don't have to do that at Amazon. They already have the cash. And so I think you've got to look at these things in better context. Now, speaking of context, and I'll lower my tone, and it'll be a more somber tone, because I know there's people out there that, believed in Intel, that maybe believed in the dividend yield, which is now zero, believed in, it being a value stock, even though the price to earnings continues to go higher and higher as the earnings continue to not just contract, but go negative over at Intel. And the company saw its shares crash. I got to imagine this is one of the worst crashes the company has ever seen. I'm seeing over 27% decline on Intel, back to $21 per share, which is a price you just haven't seen. Actually, it was a price you saw with Intel. I think it was maybe 10 or 15 years ago. Unfortunately, they laid off about 15% of the staff. I tell you what, Pat Gelsinger, if you had cut the dividend a year ago, you wouldn't have to lay off the staff. You'd have plenty of money. You wouldn't have burned through the billions of dollars. We had talked about that numerous times on our previous Intel videos, that maybe you shouldn't pay a dividend. I think they were even buying back the shares over the past 12 months. If you didn't buy back the shares and you didn't pay the dividend, you could keep the 15% of your staff, because you're going to need them to compete against companies like NVIDIA, which have fantastic leadership, and also compete against companies like AMD, which saw its shares rise on the backs of Intel completely falling apart. We'll address Intel at another time. We'll certainly talk about it this weekend on our chip show as well. Now, U.S. might consider limiting China's access to AI memory chips. It's not good for Micron and maybe SK Hynix as well. The U.S. just continuing to layer on different types of regulation and restrictions just to keep AI, high-end AI, out of the country of China. I think it's a futile effort. I think they're going to either develop this stuff themselves or get access to one way or another, in the long run. In the short run, it creates some hurdles for the country, but I just don't know if that's even worth it. Now, interestingly enough, though, ASML, which is a maker of high-end lithography machines, they rose earlier this week and then saw its shares, like the rest of the chip sector, pretty much fall after the U.S. mulling new chip export rules for China that exempt some allies, including ASML. I tell you what, these companies are probably lobbying the government with big checks. That's probably what it comes down to. Is they threaten and they threaten to even put in place some of these export controls, knowing that it really doesn't do anything, but that these corporate giants then come and donate to campaigns and grease the palms of the politicians. And that's probably what's happening now. AMD. I bought AMD and sold AMD twice this week. I'm playing a little bit of the volatility. We'll talk about that when we get to the charts. You got $500 up days, $500 down days in the markets these days, or 500-point swings in the markets. So I'm playing the bounces. AMD rose, ended the day flat to down, but on the backs of those Intel news, I got to imagine AMD is having a nice glass of champagne in their offices. And they also reported earnings, which we did an earnings video of, and we'll go in depth later this weekend on the chip show. Now, moving over to Google. Start of the week at 169.50, down 2.5%. The finish week at 165.30. We talked about on the Apple segment that they use Google's chips to train 2 new AI models. I think this is good for Google, obviously. I think this is more of a sign that Amazon's dominance in the cloud, while it's still there, AWS is still an amazing product. It's certainly not going to go away like Intel or something like that. But, man, you have other competitors in the market, and Google is certainly coming with a great product there. Now, NFL's $4.7 billion verdict, and this was a verdict against the NFL, where they were going to have to reach into their pocket and pay, I think, subscribers to the NFL Sunday Ticket. Well, that was tossed out by a judge, and this will be in purgatory, probably in the courts for a long time. That relates to Google a little bit, only because they have access and the rights to that Sunday Ticket. I can't wait for NFL season, honestly, and college football as well. Moving on to Microsoft, start of the week at $427.80, and after the company reported earnings, we saw Microsoft not only break trend, but slide down about 5%. Finished the week at $405.70. The company reported their earnings, $64.7 billion. 15% growth. You probably had a chance to take a look at the numbers, very similar to Amazon and Meta, basically saying, yeah, we spent a lot of money on data centers this year, but we're going to spend even more in the next 6 to 12 months. And again, I think that's going to be, you're going to have B of A and Elliott Management and all these people that don't really understand AI and what's actually happening, and probably haven't even opened up a Microsoft earnings report in a long time and don't really appreciate where the money is going to come from. Now, certainly Microsoft, Amazon, Google, these companies could pull back potentially on their spending over the next 12 months. Wouldn't surprise me, but they don't have to. This is like saying, hey, we're slipping into a recession here in the United States. Jeff Bezos is going to pull back. Elon Musk is going to pull back. These guys don't have to pull back. And, when we're talking about tens of billions of dollars, when we're talking about the amount of compute power that is required to train these models that these companies think they're going to need going forward, they're going to spend the money no matter what is happening with the consumer. Now, Miss Nancy Pelosi bought more NVIDIA and she sold Microsoft. So take that for what it's worth. And the Reddit CEO called out Microsoft and others for scraping its site and really the internet in general for their own benefit. He said that we've had Microsoft, Anthropic, and Perplexity act as though all of the content on the internet is free for them to use. He said that is their real position, and this will certainly change how content is displayed. I mean, we already have all these pop-ups and logins and Substacks and all this crap kind of hiding content behind paywalls, and unfortunately, that's probably going to only continue. Moving over to Tesla, start of the week at $229.33. Boom, down 9%. High beta stock here. Finished the week at 208.09. I had trouble reading those numbers for some reason. Robo-taxi Jolt, Tesla's autonomous driving test goes poorly for a Truist analyst. He said, for example, in their Model Y, it accelerated through an intersection as the car in front of us had only partly completed its right turn. My quick intervention was absolutely required to avoid an otherwise certain accident. Another interruption was required when a police officer was using kind of a hand motion to signal us to pull to the side of the road to allow a funeral procession to pass. A third intervention was less required. And look, this is the case. Now, there are some Tesla owners that post content about the full self-driving software. And for the most part, I think these are people that spent tens of thousands of dollars on a car and spent tens of thousands of dollars potentially on a software package. And they're really just posting to make themselves feel better about their purchase. None of these people, if they had a 5-year-old, a 6-year-old, or a 7-year-old, or their wife, or their grandma, none of these people with a straight face would put their son or their daughter in the backseat of a Tesla and push the autopilot button and have it just drive off and go. Nobody would do this. And I say this, and I repeat this time and time again, not because I'm trying to brag, not like I'm trying to flex, but just show you I come from experience. I have 2 Teslas. I've used the most updated version of the Tesla software. You don't have to pay $8,000 or $9,000 or whatever dollars it is. You can have a monthly subscription to it. I have the monthly subscription. It is not ready for prime time. Now, does it work on the most perfect road condition? Does it work on the highway? Is it super convenient when you're doing long drives, or you just don't feel like driving, or you get a text messages, or you have a phone call and you can turn on the autopilot? Yes, absolutely. But would you put your kid in the back of a Tesla autonomous driving car? Absolutely not. Absolutely not. It would be, I think, considered a form of child abuse if you did this. The robo-taxi is still years away. Is the software great? Is the car great? Yes. But is it ready for anything other than perfect road condition in very small? And we're talking about a $700 billion company. We're not talking about a $7 billion startup or a $700 million robo-taxi startup. We're talking about a company that has to generate billions of dollars from their robo-taxi business to actually move the needle on the stock. I don't think any of us are anywhere close to seeing that happen. Now, Elon Musk denies report of XAI considering an acquisition of Character.ai. That's maybe because Google hired Character AI's co-founders, which used to work for Google, and they got them back, and they're going to license the AI models, which I think are like talking heads that you can program to say things. Now, moving over to a very, very important technical segment of the program. We'll start with the S&P 500, which way overextended. So when you see all the bears come out of hibernation and they're like, I told you the stock was, the stock market was going to roll over. I can't tell you how many of these idiots, a lot of them actually work for the company that I just work for. I mean, they were saying, oh, the stock market's bearish. Man, the stock market's going to go down. Like, they've been saying that for like about a year now. And they basically missed out on one of the best rallies really just since October of last year. You're up 37% on the S&P 500. Forget NVIDIA, forget anything. 37%. And this is less than a year. That is obviously, that's like 3 or 4 years worth of gains in just a short period of time. Yes, we are off the highs on the S&P 500. Yes, you are down from the highs made just probably last month. You're down to 5 or 6%. Now, a garden variety kind of pullback in the markets takes you down 10%. That's probably what I think is in the cards. That would take you in the 5,100 range on the S&P 500. I think that's when you step in, not with all your chips, but these middle of the channels, which I try to divide with kind of a light green line. That's when you get a little excited. The red lines, you're not excited. You're just not excited about the stock market at these levels. Are you excited to look at your account and see it go up? Yeah, you are. But at these red lines, this is where kind of the amateurs pile in. This is where, even on the initial dip down, this is where kind of that amateur person kind of jumps in. I think you just be patient, guys. Just be patient. I think there's going to be better opportunities coming. With Meta, really have been in a trading range. Really since February of this year, you're between 450 and 550 on this one. You're basically right in the middle of it, or just above kind of a middle point. Further pullbacks in Meta, I'd probably comfortably buy this one. They should come under some pressure with their ad business being a little bit more consumer facing, small businesses coming under pressure. But you've got a little bit of tailwind as it relates to certainly the election, and that spending is priced in probably a little bit. But I think you've got a little bit of tailwind going into next year. If you do have a rapid drop in rates, and I think we will, I think we'll see 50 basis point cut really quick. That should spur some business development, and obviously small businesses is who advertises on Meta. Now, moving over to Apple, very resilient, very surprised this stock didn't sell off a little harder on those earnings. In fact, it didn't sell off at all. But from the highs that Apple made, maybe late last month, you're down about 7% off the highs. A 10% correction on Apple takes you back into kind of the two teens, the 212s, 213s. That's probably the first area with Apple that seems marginally exciting. Now, here's probably the chart of the day is Amazon. Really interesting that you had this gap in this chart that was created probably after an earnings announcement back earlier this year in January. You kind of jumped from 161 up to about 169. Well, look what happened today. You filled that gap over here with this candle that dropped. Now, interesting enough, now you've created a gap above the channel. Now, some people are saying, did Amazon break this kind of upper channel that we've been in really since January of 2023? I would say technically it kind of did. Now, we did a wick. I would wait until Monday and Tuesday of next week, because if you can somehow kind of manage to get yourself, these would be green candles, not red candles, but if you can somehow get yourself back into this channel, well, filling the gap and kind of walking back up to 180 is certainly possible. And on the longer term time frame, this would just be kind of a one-day wicking through of the trend, which certainly can happen. So I won't take this trend off right now, but in terms of Amazon, could be the start of a deeper pullback, and we'll certainly see where there's areas of support. It's a weird stock because you had this large consolidation up here at the 160s, 170s, 180s during the pandemic. You had this massive sell-off. You just haven't had a lot of consolidation in between there. There's probably areas of support down here at 145, 150. if the momentum in Amazon continues to go lower. At this level with Amazon, I think you could do some buying, but if you are somebody that doesn't like to see your account go down, I'd have some stop losses probably pretty quick on Amazon, maybe only $7 to $8 lower, because if the momentum on this one continues to go lower, there's not a lot of places I see below on this stock chart that'll catch this thing. I think you could come to 150 and even south of 150 pretty quick with Amazon, particularly if the narrative is we're slipping in recession, unemployment's going higher. Well, discretionary retail will just fall completely out of favor, and that's obviously still a big part of Amazon's business. Now, moving over to Netflix, rolled over from the highs. Nothing I would be overly concerned about. We figured when you got to these levels back up to the previous highs that you made back in November of 2021, you'd hit some resistance. Sometimes you break through these areas and just kind of power higher. Didn't happen with Netflix. Got rejected. You're off about 11% from the highs. I don't think that's enough. There's areas lower here, just lower, maybe south of 600. That's mildly exciting. Even more exciting if you get a bigger pullback in Netflix. Anything north of a 20% correction should be very, very exciting for Netflix. Now, moving over to NVIDIA. From the highs that we made back, it looks like in June, doesn't look like a big pullback on the chart, but that's only because you've made such a rapid rise in the shares. You're down about 23% on NVIDIA. Now, what's interesting about NVIDIA is they are not going to report their earnings until August 28th. So we still got about 3 more weeks until we hit NVIDIA. I think I would take a chance on this one. If the sell-offs in chips continues and you continue to get weakness in NVIDIA, I think you're buying this one only because of the bullish comments that we got from Microsoft, Google, Meta, Amazon in terms of CapEx spending. Most of that is going to flow, or let's say 80% of that is going to flow into NVIDIA. And so I think they have a chance to surprise to the upside with their earnings if you get further pullbacks. But we're still, if you kind of stretch this out, you're still at the top of the channel with NVIDIA. So despite kind of the 20% pullback, it's really a 20% off a level that really only, in my opinion, kind of newbie amateur investors were buying at these levels. This is when these are your moments to sell. When they announce stock splits, when they go over and above a channel that has been in place for 7, 8, 9, almost 10 years. This is only when kind of the newbie investor kind of buys. And we're really just kind of flushing out that money. You would need to get back in. You need to actually have to go down another 20%. Get into the $75, $80 with NVIDIA, to, in my opinion, to really, really be excited about it. Now, moving over to Google, you are off the highs on Google, but they were way overextended. I mean, you're down about 13% on this one. I think you've got an odds of getting a 20, 25% correction. And look, when you get that 25% correction, the bears are going to be doing their little, Travis Scott dances and shit like that. But a 20% correction on Google takes you right back into the upper channel. Like that, you put your Cybertruck in reverse and you are buying Google heavily in that moment. Microsoft, we talked about how on last week's show, for sure, the very steep uptrend, almost 90-degree uptrend, hockey stick-like uptrend that this stock has been on is absolutely over, but we could flatten that out. Instead of 90, we're at like a 45-degree, if you will, in terms of the uptrend. We're trying to figure out where that'll land. You have support from, if you do buy Microsoft, there should be some really good support. You notice this level right at about 400. First of all, from kind of a psychology level, 400's a round number. It had provided some support for the shares in the past. Further down from that, at about 390, there's support. Further down from that, there's 360. If I were to put a green box, somebody actually pointed out, made a good point, like maybe we should put kind of the green boxes. I remember during that kind of 2021 crash, these green boxes on the chart actually recommended where you should actually step in and buy. And we've had these green boxes on the charts really since then, and they turned out to be relatively accurate. Now, I might have tweaked these things over time, but we didn't tweak them that much. And so these buying zones turned out to be accurate. I'm not going to want to commit to this right this moment, but with Microsoft, I think you're probably approaching a box right in this range, which I think could be an accumulation zone anywhere from, call it 370 up to about where shares are right now at about $400. Now, moving over to Tesla. Technically, Tesla is a buy. Some of you probably have Robinhood accounts. You can buy this thing 24 hours, 7 days a week. Technically, from a trade perspective, this one's probably a buy. You have a support area, and with Tesla, the zones are really, really wide. Notice that our green box with Tesla, which is a buy zone, has actually held very true. Anytime you get south of really the true buy zone for Tesla is from 170 on down. If you have bought in Tesla at those levels, you have never really gotten hurt that much. But technically, you are converging two areas here, this kind of very steep, almost 90-degree type uptrend. Also the level at 207, which we've pointed out here, a conversion of two support points. I could see somebody saying, well, it's going to bounce here and maybe we make a new higher high. That's potentially possible. That robotaxi, even though I'm doubting it, plenty of other people are doubting it. There's probably even more people that are bullish, people that don't own Teslas, people that only believe the hype. They might actually think that it's really something good and we could push up into the 300s. That's certainly possible. This is the area where it'll bounce. If Tesla does not bounce at this level on Monday or Tuesday or sometime next week, you're probably retesting levels much, much lower, probably 160, folks. That was the FAANG Stock Recap Show for Friday, August 2nd. Be sure to find the links down below. Follow me on Twitter. Follow me on Instagram. Follow me on our new channel, Equity Empire. We'll have a big recap, probably an hour plus long recap of the chip sector. We'll talk about more about Intel. We'll talk about AMD, talk about NVIDIA. We'll talk about ARM Holdings. We'll do earnings recaps of ARM, Qualcomm, and the ones that we didn't publish here on the channel. It'll be a big show. I'd love to see you over there. Until then, have a fun and safe weekend. And as always, good luck with your investments.